Hello everybody, it's Yashar here, back again with another video. Today I'm excited to share my analysis of Intact Financial stock. This is a new position in my own portfolio that I recently started to buy into it. If you own Intact Financial shares, or if you are thinking about buying this stock, or if you never heard of the company and you're just curious about their business model and valuation, you will definitely want to watch this video. This is a stock that has shown strong performance over a long term. In the last 1 year, it is up 39%. In the last 5 years, it is up 138%, which is outperforming TSX by a large margin, even outperforming S&P 500, and some of the world's most known tech companies like Amazon and Shopify during this time frame. The share price actually was at an all-time high price just today. So everybody that invested in this company at any time now is in the green and made money with this stock. That's an amazing achievement. Okay, so the market capitalization of the company is approximately 55 billion Canadian dollar. The price to earnings ratio right now is around 25. The dividend yield is approximately 1.7%, and they pay a quarterly dividend of $1.33 per common share. The beta of the stock is pretty low at 0.36, suggests that this stock has lower volatility compared to the overall market. So, with all that information in mind, let's dive into their business and business model to see why they performed so well in the last couple of years. Intact Financial is the Canada's largest provider of property and casualty insurance. They also have a significant presence in specialty insurance in US, UK, and Ireland. Here's basically a list of some of the key brands and companies under the Intact Financial umbrella. So they have Intact Insurance. This is the main brand, primarily distributed through a network of brokers. They have belairdirect, a direct-to-consumer insurance company offering home and auto insurance. So this is actually the car insurance that I personally have for our cars. They have Johnson Insurance, which provides home and auto insurance again. They have Intact Prestige, which offers exclusive and tailored insurance solutions for high net worth individuals. They have RSA Insurance, which focus on UK and Ireland. Intact acquired this company in 2021. They have BrokerLink, one of the Canada's largest property and casualty insurance brokerages network. They have On-Site Restoration, which is a leading Canadian property restoration company, which is another subsidiary of Intact Financial. They project low double-digit premium growth in personal lines and mid-single-digit growth in commercial and specialty segments over the next few years, which together with margin expansion and capital deployment will result in approximately 10% net operating income per share growth, according to the management team at Intact Financial. They also have investment management arm. Intact Investment Management Arm is a subsidiary of the company. They manage a significant investment portfolio, over 40 billion Canadian dollar in assets. This includes the investment portfolios of Intact Financial and its subsidiaries, as well as pension funds and other institutional investors. The vast majority of Intact invested assets are in fixed income securities, but they also have holdings in Canadian, US, and international equities. So I think it's worth noting that Intact also has a venture capital arm called Intact Ventures. This basically arm invests in early stage companies, particularly in AI and fintech. Intact has consistently outperformed the broader insurance industry in key financial metrics, particularly return on equity, which is over 16% now. The return of equity has been significantly higher than the industry average, demonstrating the efficient management and profitability of the company. The company has shown solid growth in net operating income per share, they call it NOIPS, over time. This indicates the underlying profitability and efficiency of the business, which are all improving, and investors tend to reward this. For example, in Q1 2025, NOIPS increased by 10% year over year. Intact's expertise in pricing and risk selection, which for insurance companies they usually call it underwriting, has led to a strong and improved combined ratio. The combined ratio is basically a measure of profitability in insurance businesses. A lower combined ratio indicates more profitable underwriting. So the 3-year average combined ratio of Intact Financial is now 86.8%, which is a great number. A combined ratio below 100% basically indicates underwriting profitability of the company. So let's compare this to other insurance companies in Canada. For example, Allstate Insurance had a higher combined ratio at around 97%. The Dominion of Canada General Insurance, their combined ratio is around 96%, and Definitive Financial Corporation has a combined ratio of around 103%. Intact has also a history of successful acquisitions that have expanded their market presence and added value. For example, we can look at their acquisition of RSA in 2001. So Intact acquired RSA, which helped to expand its global reach, enter the UK and Ireland markets. Not only in Canada, Intact want to reduce the combined ratio of their UK and Ireland insurance arm as well. So when they acquired RSA in 2021, the combined ratio of RSA was 96.5%. This ratio was reduced to 92.8% by 2024, and they aim to reduce the combined ratio of their UK business to 90% by 2026. This is how Intact optimizes the businesses they acquire for larger margin of profits. The company's effective capital management allows it to continue their growth opportunities and return capital to shareholders through dividends and share buybacks. Intact has a long history of increasing its dividend annually since its IPO in 2004. They basically increased their dividend by almost 10% year over year in the last 10 years. Okay, so the business is solid. They had amazing track record of managing risks, growing their business, and returning value to shareholders. Now, let me go over the valuation of Intact Financial here. To start the model, I imported a series of general parameters from Intact earnings report, like the current share price, their revenue, their number of shares, their net debt, which is their short-term and long-term liabilities minus the cash or cash equivalents, and their net earnings per share. I also put my expected rate of return to be 12% for this stock. Now in this model, I will calculate the fair value of the stock by projecting their future net earnings and then discount the terminal value on future earnings minus the liabilities of the company back into the present value of the stock based on 3 different scenarios. In the bear case, or the most negative case for the stock, the business will have a little bit of margin compression. I consider 2% share dilution and 0% share-based compensation, and I assume they are able to grow their revenue by 7% in the short term, 6% in the midterm, and eventually by only 5% in the long term. And I consider a terminal multiple of 12, which is in agreement with historical bear periods of this stock. For base case or normal case, I considered a little bit better margins, revenue growth, and a terminal multiple of 18, which is historically an average multiple for this company. Finally, in the bull case or best possible outcome, I considered a little bit profit margin expansion, a 0% share dilution, a 12% short-term, 11% midterm, and 10% long-term growth, and a terminal multiple of 24, which is definitely a bull multiple for this company. Note that these assumptions in the bull case is pretty much what management team of the company projects for the next 5 to 10 years of Intact, and based on history, they usually were able to hit these targets. Now, if I hit calculate, the software will give me some valuable information about this stock based on my assumptions. It gives you the intrinsic value of the stock in each scenario, and then it will provide you with a fair value estimate, which is $293 Canadian per share for Intact. And compared to the current share price, Intact still trades at almost 7% premium today. It is basically close to its fair value, but it is not a buy according to the model. It means based on the current assumptions that I have here, the Intact Financial stock is barely able to return more than 12% per year in the next 10 years. But for such a high quality business, I personally don't mind to pay fair value and a bit of premium. I personally started an initial position, and I'm waiting for a dip in stock price to buy more shares of Intact Financial. I don't mind buying a couple of shares even at these levels, but if I see a major dip, this company is a solid choice for investing your money. Okay, there you are guys. I hope you enjoyed the video, and if you enjoyed the video, consider subscribing to the channel to see similar videos. I will come back with a video about my portfolio soon, but until that time, I see you guys in the next video. Farewell.